Every day, I approve other people's retirement paperwork. Tuesday, I finally opened my own. And 3 things came out of it that I did not expect. 1, the number itself. 2, why the number lies to you if you only look at the balance. And 3, the part that actually kept me up. What happens to that money the day the government decides it's their turn? I've processed retirement enrollments for this company for over a decade. I know the forms better than most people know their own handwriting. I've told dozens of people, gently, that they're behind. What I'd never done, not once, was run my own number through the same math. So this week, I did. I've watched people open this exact statement at 62 and go pale. I always assumed that wouldn't be me, because I check the box every year. I max what I can. I do the responsible thing. Turns out responsible and correctly structured are not the same word. Quick pause. If you're new here, I'm John. This channel is where I document my own numbers in real time, mistakes included. I'm not a financial advisor. I'm the guy in payroll who's seen 1,000 other people's retirement accounts and finally looked at his own. If that's useful to you, stick around, subscribe, new video every couple of days. No fluff, just the actual math. Okay, back to my form. Here's the first thing, the number itself. In context, every year, retirement research firms publish 401k balances by age bracket, and 2 numbers inside that data tell completely different stories. For people 55 to 64, the average balance is just over $300,000. But the median, what the person standing exactly in the middle actually has, is around $107,000, less than half the average. My own bracket, 45 to 54, averages around $215,000, the median, under $80,000. Why the gap? A small number of very large accounts drag the average up. Most people are nowhere near it. And the industry rule of thumb doesn't help much either. By 67, you're supposed to have roughly 10 times your salary saved if you started saving 15% a year in your mid-20s. Nice sentence at 25. Gut punch if you're staring down 50 and nowhere close. Here's the closest comparison I can give you, because it's something everyone already understands. You already know your paycheck has a gross number and a take-home number, and you'd never plan your life around the gross one. A pre-tax 401k balance is a gross number. The account statement shows you gross. Nobody sends you a statement showing net. What's actually going to land in your pocket after the government takes its share? You have to go build that number yourself. Almost nobody does. Almost so. And I don't think it's laziness. I process enough forms to know most people genuinely mean to check. Retirement is 30-40 years away when you start, and a statement that only shows one number, the big one, the gross one, feels like good news. Nobody wants to do the extra math that might turn good news into a smaller number. So the statement stays unopened past the total on the front page. Mine did too, for longer than I'd like to admit. Here's the part nobody in payroll tells you, because it's not their job to. A big 401k balance is not the same thing as a big amount of usable money. A $400,000 account, sitting almost entirely pre-tax, can behave, in your 70s, like it's worth a lot less than that once the IRS and Social Security taxation and Medicare premium surcharges all take their cut in the same years. I'm going to show you exactly how that happens, and more importantly, what I did the moment I saw it happening to my own account. Rough version, so this isn't abstract. Say your account is worth $400,000, almost entirely pre-tax. Once you factor in ordinary income tax on every dollar you withdraw, plus the way it can push more of your Social Security into taxable territory, a reasonable working estimate is that somewhere around a quarter of that account was never fully yours. It was always going to be split with the IRS. You just hadn't been shown the split yet. To be clear, that quarter is a rough illustration, not a formula. Your real number depends on your state, your other income, and tax rules that can change between now and the year you actually retire. But the direction of it doesn't change. A bigger pre-tax balance means a bigger future tax bill riding along with it. Quietly, every year you don't plan for it. I want to be honest about something. I'm in my mid-40s. I'm not behind the way some of the people whose forms I process are behind. But I'd made the exact mistake I warned people about without noticing. Almost everything I'd saved was pre-tax. Every dollar of it fully taxable the day I touch it. I'd built a bigger number and quietly built a bigger tax bill to go with it and never once separated the two in my head. That's the moment my coffee went cold, because I do this for a living. I tell people to think in buckets, and I hadn't done it myself. Here's the mechanism, since this is the part that actually matters. Every dollar you defer into a traditional 401k comes out later as ordinary taxable income. it can push you into a higher bracket, it can make more of your Social Security taxable, and past a certain income in retirement, it can trigger higher Medicare premiums, a penalty most people have never heard of until the bill shows up. And it doesn't ask permission. Once you hit a certain age, the government requires you to start pulling a minimum amount out of these accounts every year, whether you need the money that year or not. If your whole balance sits in one pre-tax bucket, that forced withdrawal lands on top of whatever other income you already have, and that's exactly the year your bracket and your Medicare premium can jump. A couple of years back, someone retiring from this company came by my desk with a number on their statement that looked, on paper, like a genuine success story. 6 figures, decades of consistent contributions, nothing to be ashamed of. What they hadn't planned for was the year they'd actually have to start pulling from it, on the government's schedule, not theirs, stacked on top of a pension and Social Security they'd forgotten to add into the same picture. Their real spendable number was meaningfully smaller than the one on the page. I remember thinking, quietly, glad that's not going to be me. Then I never checked my own account for 2 more years. None of that shows up on your account statement. Your balance just says $400,000. It doesn't say, and about a quarter of this isn't really yours. So, what do you actually do? Here's what changed on my end this week, and it's not complicated. 1. I split my new contributions. Some stays pre-tax, some now goes Roth, so future me has a pool of money that comes out completely tax-free. Concretely, that means every paycheck now, a piece of what I was putting entirely pre-tax goes into the Roth side instead. Smaller tax break for me right now. Considerably less taxable income showing up for me 30 years from now. 2. If you're 50 or older, there's a catch-up contribution on top of the normal limit. Meaningful extra room specifically built for people trying to close a gap late. Use it if your cash flow allows it. I'm not there yet, but I already know it's coming, and I'd rather plan the cash flow for it now than scramble for it the year I turn 50. 3. And this is the one people skip. Model your withdrawals before you retire, not after. Which accounts you pull from and in what order changes your tax bill more than almost anything else you'll do in your 50s and 60s. 4. I stopped treating my 401k balance as a single number in my head. Now it's 2 numbers. What's pre-tax and what isn't. Because those $2 are not worth the same thing, even sitting in the same account. I'm not fixing 25 years in one afternoon, but I moved the number that matters, not the balance, the mix. So back to that form on my desk. The one I've stamped approved for other people 1,000 times. This time, it had my name on it. And here's the honest reason I'm telling you all this on a channel, instead of just fixing it quietly and moving on. I spent 10 years being the person who tells other people they're behind. It took my own coffee going cold at my own desk to actually do something about it myself. If it took me that long, with all this in front of me every day, I'd rather you not need the same wake-up call. The form isn't the point. It never was. The point is, I finally treated my own future like it mattered as much as everyone else's file on my desk. I don't know exactly what my number looks like in 30 years. Nobody does. But for the first time, I'm building toward one I actually understand, instead of one I just assumed was fine because it was big. If this helped you look at your own number differently, not the balance, the mix behind it, that's genuinely the only reason I make these. Subscribe if you want to keep tracking this with me. I'm not going to pretend I have it all figured out. I'm just going to keep showing my actual math. Next time, I'm opening the half of my 401k I didn't even mention today, the safe part. Because while I was busy splitting pre-tax from Roth, I never once checked what's actually sitting in the bond side of my account. Turns out, SAFE had a number attached to it the whole time, printed right on the fund's fact sheet that almost nobody ever reads. It's the same number that quietly moved your mortgage rate, your savings account interest, and my retirement balance, all at once, all from one market most people have never looked at. I'll show you where to find that number on your own statement and what it would have cost you in 2022 if you didn't know it was there.